23 seconds away from the opening bow this morning. Good morning. Equities doing okay, up by 1% on the S&P. On the Nasdaq, up by 1.2%. Will it stick? And can the S&P 500 break away from 4K in a big way? Over the last few months, going back to November, just in and around 4,000. 5% up, 5% down, but can't get away from it. Let's your opening bow, switch at the board and get to the bond market. Yields look like this, higher by 2 basis points. Let's call it 360 on a 10-year, 359.43. In the FX market, euro dollar 108.36, negative 0.1%, and crude back nicely in the 70s over the last week or so, up 1%, 73.99 on WTI, just short of 74. About 20 seconds into the session, your equity market shaping up as follows. A lift up 0.9% on the S&P. We had some weight back into the Nasdaq, up more than 1% on the Nasdaq right now. What stock to watch at the open? Micron. Shares moving higher after issuing a better than expected outlook. The CEO saying this: customer inventories are getting better, and we expect gradual improvements to the industry supply-demand balance. Ed Ludlow on a story. Morning, Ed.
Yeah, good morning, Jonathan. That statement and also the forecast for the fiscal third quarter of sales at $3.9 billion above street expectations is being taken by the market and a number of sell-side analysts to mean that the down cycle we have seen in memory-related chips may be nearing a bottom. Remember, Micron does not have a very diversified business. It's the biggest maker in the US of memory chips, but it competes with Samsung, SK Hynix in an industry that has really seen its end market slow down. We're talking smartphone handsets. They do have some offerings when it comes to data centers. That market for data center memory bottomed in the fiscal second quarter, the quarter just gone, according to Micron. This terminal chart, though, is critically important. It tells the story. The loss that's expected in 2023 is the widest, the biggest deficit for Micron, going all the way back to 1984 when they first went public. The story of the last 12 months is that this has returned to a cyclical industry, boom and bust. There has been bust when it comes to memory chip. What we're seeing is that actually, instead of making new orders, smartphone companies and other device makers have been working through their inventories and backlog. That's what we're talking about here from the CEO. That situation's improving, and I think what we see is the upcycle potentially starting in the second half of this year. We're trailing the Philadelphia Semiconductor Index on a 12-month basis and also a year-to-date basis, but looking on the gains at Micron, we're now up more than 4%, closing that gap in performance terms.
A nice move there this morning. Ed, thanks for that. Bigger move here. Lululemon absolutely flying, overcoming its own inventory issues and delivering an upbeat forecast. The CFO had this to say: looking ahead, we remain optimistic regarding our ability to deliver sustained growth and long-term value for our stakeholders. Katie, that stock up more than 12%.
Absolutely surging, and all of that is just a fancy way to say that leggings are in high demand right now. Athleisure, super hot. That's what we heard from Lululemon last night. And that gain that you're looking at, 13% as the bell rings, that is the biggest gain in 3 years if it holds. And that all comes down to the outlook that this company delivered last night. The headline figures topped estimate. Lululemon sees revenue at $9.36 billion. Analysts had been looking for $9.1 billion. Adjusted EPS guidance also beat, is seen at $11.61. That's about 32 cents higher than the estimates. Sales growth, meanwhile, that measure is actually seen slowing. Sales are expected to rise about 12% in fiscal 24, 14% in fiscal 25. That's still double-digit growth, though, John, and shareholders seem to like it.
I don't like that Midtown uniform, you know, that the guys are wearing with the Lululemon pants. Do you know that one?
I'm well acquainted with it. I got to say, it's all about the range of motion.
Yeah, not a fan. Not a fan. Katie, thank you for that, as always. The stock's flying. It's doing nicely, up by 14%. Close here could be one of the biggest day of gains we see for that name, going back to spring 2020, and that's when fashion just collapsed. You remember. The team at Jefferies throwing some cold water on the retailers, saying this: maintaining their underperform rating, better 4Q and better outlook, but our concerns haven't gone away. We remain guarded as competition rises and the consumer environment slows further. That's the latest from them on that name. Elsewhere, UBS have this to say: Hammers is out, Emotti back in.
I'm fully aware that we need to work very hard here to avoid any consequences for the taxpayers in Switzerland. So I think you have my word and commitments that together with my team, we will work and do everything that it takes to make this transaction successful.
Marion Halftermeyer joins us now from Zurich. Marion, big news, Emotti's back.
Definitely. So it's a ghost from the past for UBS. You know, he was the former CEO of UBS and led really that bank to a stability, to the behemoth that it is today and the stable bank that it is today post the financial crisis. And now they've said, you know what, he's the best horse we have in the book to help us through this transition of really taking in Credit Suisse and sorting through this very complicated integration that will take a number of years to complete.
You might have to deal with some Credit Suisse regulatory issues as well, maybe even some fines. Marion, I was just wondering what your thoughts were on that statement that came from the Senate Finance Committee Chairman, Ron Wyden, a little bit early this morning, and I can share the quote with you. At the centre of this investigation, greedy Swiss bankers and catnapping government regulators, and the result appears to be massively ongoing conspiracy to help ultra-wealthy US citizens to evade taxes and rip off their fellow Americans. What's Switzerland make of that comment this morning?
This isn't an entirely new comment, right? I mean, Switzerland has had to deal with the tax evasion issue for a long time, and there were a lot of settlements back in 2014, 2015 with Swiss private banks. So, you know, it's unfortunate timing for this acquisition, and it will be something that UBS will have to deal with both from its own perspective if it's involved, but also from Credit Suisse's perspective, and the landscape itself is now being questioned. Okay, you know, are they doing things they shouldn't be doing?
Marion Halftermeyer, thank you on the latest over at UBS, and this is exactly why UBS, I imagine, pushed for that government guarantee a couple of weekends ago, just in case there was a big fine coming because you inherit problems from the likes of Credit Suisse. We mentioned this a few times over the last couple of weeks. Clearly, the regulators and officials have learned their lessons from 2008 and the financial crisis based on the actions we've seen over the last couple of weekends. We've also said, clearly the banks have learned their lessons as well, based on what happened with some banks, I'm thinking of JP Morgan, helping out others in the financial system, and then inheriting their legal issues on top of all of that, which is why perhaps UBS pushed for that financial guarantee. Sarah Hunt of Alpine Saxon Wood seeing opportunities elsewhere in energy. Energy stocks have been weak due to lower commodity prices and fears of recession. We think there is an opportunity there. Sarah joins us right now. Sarah, if people think we're facing a disinflationary bust, why do I want to be in energy?
I don't think that you need to rush into energy. I think that you have time, but I also think that there's a bit of complacency going on now that we've had a warm winter in Europe. And we've seen, you know, the question of what's going to happen with China, whether or not we're going to get a recession in the U.S., that's all been weighing on commodity prices. But I think that you will have some issues as we get into the summer, if we have a very hot summer, because there is a weather component to energy. But I also think that you've got, you know, as I've said earlier, years of underinvestment in energy and traditional energy. And I think that there are both interesting opportunities on the more traditional energy side, like a Devon, and I also think that something like a Chart Industries that plays into LNG is also a very interesting situation where it sits right now.
Sarah, do you think we are facing a disinflationary bust? Is that your underlying assumption here?
I think there's so much right now that depends on what happens with the economy, and there are so many. It's such a wide sort of probability curve right now, because it's really hard to figure out, are we completely done with this banking crisis? If so, that would be an unusual, very short version of what could go wrong when you have a massive change in interest rates. Do we have a slowdown economically across the world? Does the U.S. slow down? Does China come out of this faster? I think the U.S. is still experiencing a lot of economic prosperity on the back of 2 years of sitting at home and not doing anything. So I think that there is a very uneven recovery in this economy, so it's very difficult to parse out exactly how this goes forward. I think it's difficult, however, not to assume that some of this credit tightening that's going to come about because of the banking issues is not going to slow the economy. The question is, how slow does it get?
So Sarah, the other question then is, where do I want to take cyclical risk? Some people are just going into tech. Lower rates, a rate cut away from another tech boom. We've all heard the same thing, Sarah. Are we underestimating the cyclicality in that sector?
I think that you had such an overreaction to higher interest rates in some of the larger tech stocks where there still is going to be growth that didn't really need to have lower interest rates in the way that people sort of expected. So I'm not sure where that goes, but I definitely think that there's growth in the tech sector. So you're going to see people going back in there, as you've already seen. I mean, the best performance so far this year has not been in the cyclical sectors or the economically sensitive sectors. It's really been in the tech sector. Even as interest rates started to go higher, there was sort of a snapback from last year because those stocks were down so much. And I think that it's more likely that the Fed pauses than turns into an abrupt cycle of cutting rates unless there's much more stress in the economy. So I don't think that we want to see the Fed cutting rates because I don't think we want to see the stress in the economy that would force that.
This is something Wei Li of BlackRock said as well, Sarah. I'd love your response to that. Just a number of weeks ago, I'm not talking months, years. I'm talking about a couple of weeks ago. There was still this belief that the Fed put was gone, that the regime had changed. Waley of BlackRock said this: we don't see rate cuts this year. That's the old playbook when central banks would rush to rescue the economy as recession hit. Do you take that side of things? Does that resonate with you?
Well, I think if you just look at what happened in the last couple of weeks with the banking crisis that we had in March, the ECB hiked rates 50 basis points. The Fed did not pause completely. There was some thought about hiking 50 basis points before we got through that banking crisis, but the fact that they raised 25 basis points also says that they are really worried about inflation. And I think the historical playbook in the last decade has been there's no inflation to worry about, so we can do whatever we need to with rates to make sure that we stimulate that economy. We're in a much different situation now, and the tensions are much stronger between I want to cut rates because I see things, going apart in the financial world versus I've got this inflation issue on the other hand. I think it's going to be very difficult, and I think you're also starting to see the slowdown that's coming from high rates in things like auto loan, people being accepted for auto loans and things along those lines. I think that is just starting to happen. And so it's not so easy to turn around and cut rates here with the backdrop the way it is.
Sarah, I want to finish on the market at the index level. The S&P at 1%, just north of 4K. Sarah, you can take that chart back to November. This index on the S&P 500, one way or the other, has struggled to get away from 4,000, Sarah. What is it about this level?
You could talk about the psychological level of round numbers, right? 4,000 is a flat number, and it didn't go to, it's been stuck in a range. But I think that just talks about the uncertainty that we have right now, both on the economic side and on the financial side. First, you had, rates going higher and people were piling money into bonds and treasury bonds, and then the incredible drop of treasury bonds. Like, look at the 2-year that went from 5% to 3.5% in basically 5 days. I think that also sort of pulls money, put money back into things like money market funds as people wait for the stock market to go higher. I think that we're just experiencing some real uncertainty on both the financial level, the economic level, and I think that is translating into a market that really is kind of stuck in between. Are things going to get better, or are things going to get worse? And I don't think we know the outcome to that right now.
Sarah, the range on this 2-year this month, unreal. Sarah Hunt of Alpine, thank you as always. The range on this 2-year this month, 5.08% intraday high, 5.08, 355 intraday low, and a couple of weeks separate the intraday high and the intraday low of 5.08% and 355, all at the front end. Right now, let's call it 4.1% on the 2-year. Coming up, the debt ceiling fight heats up in Washington.
I don't know what we're going to meet on. The deal was we each put down our budget.
That conversation up next.
MAGA House Republicans want to add over $3 trillion to the debt. They've even suggested they won't release a budget so they can hide how much of their deep and harmful program cuts are just paying for their tax cuts.
President Biden and Speaker McCarthy locked in a duel over the debt ceiling. McCarthy sending a letter to the president demanding they begin negotiations on spending cuts and regulatory changes. Biden pushing back with a letter of his own, challenging Republicans to produce a public budget plan first. AMH down in D.C. Anne-Marie, lots of noise, little change.
Yeah, John, what you're seeing right now is that these two parties are really just digging their heels in for this standoff, and it comes as we were just getting ever so close to reaching that debt ceiling, the X date. Secretary Yellen had said, look out for June. A lot of people are talking about July or August, but the fact of the matter is you have these dueling letters, and what the president responded to Speaker McCarthy, who, by the way, the speaker told the president he needs to start rolling up his sleeves and getting to work in a discussion, is that the Republicans need to put a public budget plan first so that all of Americans see what they want to do, and he wants them to do before they leave for a 2-week recess for Easter. The president, though, didn't say he would not meet Speaker McCarthy, and besides the letter, when he was boarding Air Force One yesterday, he told reporters, I just don't see the point of sitting down with them yet. What is there to discuss? So the White House is once again putting it back in the House GOP hands.
So AMH, in the meantime, we're all talking about the same thing, which is the X date. I speak to people on Wall Street, as you know. They're not taking this seriously until we get close to that. I'll ask them a question. They'll give me the same response. Where is that X date?
Yeah, we don't know the precise X date, but everyone's talking about the summer where this could really come to a brink. And I think now this is why the financial markets aren't freaking out just yet. But when they do, potentially it's the financial markets that are going to be the ones to push Republicans and Democrats to get on the same page and make sure that they can raise the debt limit. Jonathan, when you talk to a lot of people, they talk about 2011. They had the votes, and yet still the U.S. was downgraded, and that's because the financial markets took notice and there was a bit of panic.
So you're on Capitol Hill today. We had day one of the hearings yesterday. We've got day two in front of the House today. Anne-Marie, I noticed two distinct arguments, and maybe it's a bit of both at the same time for some people, but one, do we need more regulation? People think we do, of the banks. And two, did we just have a lack of enforcement of existing regulation given what they knew when they knew it and didn't do anything about it?
Yeah, these are 2 points that you're likely going to hear brought up again today. When it comes to new regulation, this is something that Democrats really want to push. You also heard from Michael Barr, the Fed Vice Chair of Supervision, saying that they may themselves boost the capital liquidity requirements for banks worth about $100 billion or so. But then when it comes to what did they know and potentially just not executed on, this is where Senator Tester really made a point. He said, it sounds like you knew there was a problem, but no one brought the hammer down. And Michael Barr said that there was warnings there about SVB, the fact that they didn't hedge against their short-term paper in this higher interest rate environment. So you're going to hear a lot of that, Jonathan, today, but you're also going to hear a lot of partisan voices as well. Today, expect Republicans to go after quote-unquote woke banks, that they were too focused on ESG, and for Democrats, it's really going to be about the fact that there's this loosening of regulation, and they want to see more regulation put on these mid-sized banks.
The guy we're not talking about is the Fed chair, Jay Powell. And at what point the Board of Governors knew about all of this stuff, Anne-Marie? When did it hit his desk? Did we get much clarity on that yesterday?
Yeah, not much. We do know that Michael Barr was really brought to the surface of all of these problems in February, so potentially that is when, as well, Fed Chair Jay Powell also was aware. When it comes to the Fed Chair, Jonathan, we should note that Barr was pretty honest yesterday and also saying that they would be a little bit more welcoming and open, as the Fed Chair said as well, to an outside investigation. This is something that a number of lawmakers have called. Why should the Fed be investigating themselves? Potentially we need to bring in an outside probe.
MH, great work as always. Looking forward to day two of the coverage and you leading it. Anne-Marie will lead the coverage through the day and then again at 5 p.m. Eastern time. Balance of power with Joe Matthew. Looking forward to that. Speaker McCarthy then, bit of tension between him and the president, bit of tension between him and Beijing as well. Bloomberg learning the White House National Security Advisor spoke with China's top diplomat just last week. The country now warning Taiwan's president against meeting with Speaker McCarthy during her trip to America, writing this: if she meets with McCarthy, it will be another provocation that severely violates the One China principle. We resolutely oppose this and will definitely take measures to respond. Emily Wilkins joins us now for more. Morning, Emily.
Good morning, Jonathan. Well, certainly some very interesting developments going on, both with National Security Advisor Jake Sullivan speaking with China's top diplomat. Clearly an effort here by the Biden administration to start bringing the temperature down again on the relationship between the two countries after tensions really got raised with some of those balloons that were floating overhead. And so this is the Biden administration's attempt to really get things back on track, to potentially set up a call between Biden and Chinese President Xi Jinping, and to sort of reestablish some of those connections between the two countries. Of course, right as this is happening, you have Taiwan's president coming on a 10-day trip to the U.S. where she is expected to meet with Speaker Kevin McCarthy in Los Angeles. Now, you mentioned that that threat has sort of been issued, this warning that McCarthy should not take the meeting. But from what I have heard from Kevin McCarthy when it comes to Taiwan is that he is every bit as eager to be just as aggressive as his predecessor Nancy Pelosi was. I mean, certain concerns did not stop her from going to Taiwan. And at this point, it seems like McCarthy is just as eager to be just as aggressive, just as hawkish, and to have this meeting with Taiwan's president. Of course, we'll see what the next developments are here, but it's certainly something that McCarthy is eager to do, is to kind of put on that very aggressive, hawkish stance.
Emily, just quickly, consequences. This is what China had to say, the Chinese government. We will definitely take measures to respond. Do we know what they are?
We don't know at this point what they would be. I mean, certainly we can look to what happened after Pelosi had her trip to Taiwan with some of the increased military action in the area. But I think to a certain extent, this is all going to have to be a balance game. That Biden administration, they want to have that working relationship with Beijing. They want to keep the lines of communication open. But at the same point, being aggressive against the Chinese government, it's one of the few areas of bipartisanship and one that lawmakers are looking to.
Emily, thanks for that. Let's get back to the market. 23 minutes in, equities up by 1%. Katie has some sector price action. Hey, Katie.
Hey, John, all 11 sectors in the green right now. Real estate leading the way. Healthcare, your relative underperformer, still up about 0.4%. I want to talk about chips, though, because you have the SOX index outperforming today, up 2%. Look at the year-to-date board, up 23% this year,
wow.
24%. Not bad.
What a move, Katie. Thanks for that. Up next, your trading diary from New York. This is Bloomberg. As always in this situation, there's one question. Will it stick? Decent day of gains on the cards right now. 25 minutes in, up by about 1% on the S&P, on the Nasdaq, up by 1.4%. That's the price action. Let's get to the trading diary. Bank hearings continue on Capitol Hill, top of the hour. Then we get economic data from pending home sales on Thursday. US GDP, another round of jobless claims, plus more Fed speak. Kashkari, Barkin, Collins on deck, followed by Williams, Waller and Cook on Friday. And we close out the week with a UMich sentiment survey. I just wonder how important the incoming economic data is now, given the banking difficulties of the last couple of weeks. And I've mentioned this a few times, data dependent on what data? Is it a banking situation or CPI and payrolls, retail sales and all of the above? We'll continue that tomorrow. From New York City, this was the Countdown to the Open. This is Bloomberg TV.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Into the U.S. trading day, Wednesday, March 29th. Here are the top market stories that we're following for you at this hour. New bank regulations, they're a coming. It is day 2 of bank hearings on Capitol Hill. We're going to try to figure out when new rules and tightening credit will actually hit the economy. And Sergio Amati, he's back. UBS brings the former CEO back to help handle the acquisition of Credit Suisse. We're going to try and look at how to value the bank with big execution risk. And who's in the mood for tech? You got the NASDAQ 100 looks set for its best quarter since 2020 as Micron gives a better than expected outlook. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. And welcome everyone to Bloomberg Markets. I get that the tech story right now is about Micron. Yep. I get that we're looking at maybe a bottom rather than growth for the semis, and I hear that. But the rally in the equity market versus the underlying economic data that we still talk about in terms of credit tightening, just those two things don't make sense to me right now.
Yeah, the tech rally is really interesting because it does seem to be pricing basically a kind of duration story. We're going back to the old playbook. Rates come down, you buy tech. In some ways, that logic still applies. I think the chip story is interesting. I think Micron's interesting today. I think you've got an upgrade to ASMI here in Europe from Morgan Stanley. You've got the Infineon out. The Infineon outlook absolutely smashed it today. So there's a whole bunch of positive chip news, but I think you've got to segment that sector into its component parts. Infineon very exposed to what is happening with the autos. But the data story I think is really interesting, Alex. Here you go. You've got pending home sales coming through month on month, 0.8. That's down from 8.1, but it's better than the negative 3.0 that the market was expecting. I've got my Weco screen up in front of me. I've got data coming out of my ears over the next few days. I've got PCE coming out. I've got ISM next week. You've got JOLTS next week. Why do I care about any of this data, Alex? None of it is relevant right now. The only data that I think you need to worry about is what is coming out in terms of the bank story. You've got the term funding stuff coming out on Thursday after the close. You've got the deposit data coming out Friday after the close. Isn't that where the narrative is right now? Yes, we're data dependent. Pick your data.
But if banks are really going to hit things like commercial real estate, for example, or commercial industrial lending, for example, does that actually hit the consumer? Can the consumer still go buy $100 yoga pants? Do they care about commercial real estate blowing up and certain banks' balance sheets getting hit? I feel like that's becoming the conversation now, that maybe we can be okay even if areas of the economy are weaker. I think that's pretty interesting.
Lululemon's having a really solid day today. Yoga pants, apparently still quite the story. Maybe people have basically worn out their yoga pants that they bought during the pandemic and are now having to buy new yoga pants. I may be
completely making this up, by the way. Anyway, we'll discuss that.
This is one area that apparently Alex Steele does not shop in, but we can, again, come back to that as well. Our question of the day, therefore, is when will we see the banking crisis hitting the economy? We're talking about this idea that basically you've got a tightening of lending standards that is going to hit the economy. But when does it show up in the economic data? Because you look at the consumer confidence data yesterday, certainly wasn't there. So let's try and answer this question. Bloomberg's international economics and policy correspondent, Mike McKee, joins us. He's in Washington. He's got a great interview lined up for tomorrow. Liz McCormick, Bloomberg's chief global markets correspondent, joining us to give us that side of things. Mike, I'm going to start with you, not Liz. Let's talk about how the Fed is making decisions right now, because the market is really confused, and I give you Exhibit A, which is the US 2-year, which is all over the place right now. It doesn't know which data to look at. When are we going to see this banking crisis showing up, and where should I be looking for this banking crisis to show up?
I'm tempted to say Wednesday at 4:30. Actually, it is going to be some of the more marginal, what you would think of as minor indicators that are going to tell us the story of banking, at least in the short run. Definitely today, the Fed's balance sheet numbers, when they come out at 4:30, and Friday with the bank lending numbers coming out at 4:15. The biggest question is going to be, as you say, are banks going to tighten lending standards? Well, they already have. 43% of banks in February said they'd tightened lending standards because the economy was slowing down. Now, do they go much further than that, or do they need to because of a couple of idiosyncratic banks, or at least that's what it looks like right now? That's going to take a while to find out. But if you take a look at the lending numbers so far, even with that tightening of standards, we've seen bank lending and small bank lending not only hang in there, but as of last Wednesday, rising. So another number we're going to want to take a look at today. But it looks like at this point the banks are holding in there. And so if that's the case, then there will be less of an impact on the economy than people feared.
Hey, Liz, what do you think? Because that's going to really dictate, like, do you want to go buy this tech rally, for example?
Right, and I think Mike hit the nail on the head. People are saying lending standards were already tightening a little. And, you know, I talked to an investor yesterday, and he said, which I think is getting to what Guy you're getting at, is
this banking, quote unquote, he said, crisis kind of threw sand in all of our eyes. We're trying to figure out how much of a crisis is it or not. And that's why I think this lending data is kind of must-see data to watch. But, you know, I was looking at Bloomberg Economics did this great study back to the 1800s and looked at banking crisis and said, yeah, they always slow things down and are disinflationary. But they were saying this time around, it has to be more than just, not that this isn't bad, but these 3 regional banks going under, it has to be worse than that to really, you know, cause a major headwind to the economy on that front alone. So I think that's what we have to see. Does it spread? You know, like you guys are saying with the 2-year yield, every other day the market's like risk on, risk off. They can't make up their mind.
And Liz, the swings are massive in the 2-year. The 2 years all over the place at the moment. What is the market looking to at the moment for guidance? When you talk to people, what are they saying? What is their North Star right now in terms of how they're trying to sort of plot the course?
Well, I think the problem is everyone has a different North Star right now. Some people are saying, hey, we still have to see the actual data. Others are saying, like you kind of mentioned, that data is actually lagging. So we really want to see, you know, what happens each week. Do banks keep tapping the discount window on the new lending facility, the Fed said, and do deposits keep outflowing? So there's a mix of things. But, you know, I talked to someone who said, like, I've been in the market 35 years, and I have never seen the 2-year yield move like this. And I was talking to the guy who created the MOVE Index, which we all love, and he was saying, you know, it's weighted. But if it was all weighted the 2-year, it would be off the roof, and it's already high. So I just think the market can't make up its mind. But it is still leaning into easing, you know, by the Fed, which we don't know if it's going to pan out.
Exactly, and that's what's really confusing and also contributing to all the whippiness, right? You have, Mike, market pricing in rate cuts. Labor market's still strong. You have estimates for GDP continuing to roll over from the shops, but on the equity side, you're still seeing relatively high earnings expectations for this year. You're still looking at inflation coming down, but still above 5, yet the hikes, the cuts are priced in. All these things cannot coexist together.
Well, maybe they can. I mean, I think what you're seeing is something that has happened in the past. We don't have a lot of statistical evidence in these kinds of situations. Recessions are not that frequent, but we have seen the economy chug along just fine with interest rates where they are now. That was the story in the 1980s and even the 1990s when we saw the tech bubble. So it's possible for things to go on like they are. Not everyone is going to get an Alex Steele mortgage, but they're still going to buy houses. We saw mortgage applications rise in this past week. So as people get used to it, things may not need to come down as quickly as people thought. The problem is that for so many years, the markets have basically relied on a Fed forward guidance, and that forward guidance was basically 0 rates as far as the eye can see. And so they don't know what to moor to at this point. And we're going to see that kind of volatility going forward. Leaning into 4 rate cuts, you said, that's true, but there's no conviction on that at this point, and certainly that is not what the Fed is thinking.
Liz, in terms of the color, the nuance that we're going to need to get to kind of figure out what is happening here, we're not actually that far away from the bank reporting season. It's only in a few weeks' time we're going to hear from JP Morgan. How useful, how more important do you think this bank earnings season is going to be relative to how important they are normally?
Well, yeah, of course they're always important, but I think you're right. That's what people are looking at. We want to see, because despite all the gyrations in the bond market, the equity market's held in pretty well. It's off the highs, but the volatility levels are lower there. And people are saying, we have to really see it, Are the earnings really going to, and the forward guidance on the earnings look worse than they've been? So I think the market's really hinged on that. Because again, like we said, people want to see really the stuff that's forward looking, as much forward as we can see. So I think, even the bond folks are really looking at that to see, are we starting to see more of a crumbling of guidance on earnings from a large swath of companies, not just certain sectors.
Right. And also, do earnings represent the underlying real economy? I mean, we have to ask that question too. All right, guys, thanks a lot. Good way to set us up. Mike McKee, Liz McCormick, thank you both very much. All right, coming up, it is day 2 of congressional hearings investigating U.S. bank failures. We have Mark Calabria, a former financial regulator and senior advisor to the Cato Institute. He'll be joining us next. This is Bloomberg.
So federal regulators on the banking front are in front of the House Financial Services Committee today. They were in the Senate yesterday. We're obviously talking about the same subject, the recent bank failures, SVB and Signature Bank. It got pretty feisty yesterday. The ranking member, Tim Scott, certainly pointing some fingers. Are we going to see something similar today? Let's go to Washington, to our Washington correspondent, Anne-Marie Jourdain, who's outside their hearing room. Anne-Marie, how different will today be from yesterday, or are we basically going along the same lines? It got pretty feisty yesterday.
Well, I would actually argue that today would be a lot more feisty. What you see a lot of the times on the House side of the hearings, I mean, remember, these individuals have a different kind of election path. It's much shorter when they're up for re-election. A lot of these moments are really for them to push out YouTube videos that they are talking tough on regulators or officials when it comes to big problems. So it could potentially have a little bit more color. We just heard from House Financial Services Chair Patrick McHenry, and what he said is that Congress cannot legislate competence. So what you are going to hear a lot again is these questions to the supervisors, the regulators. What you heard from Senator Tester yesterday was that the regulators knew what was going on, but clearly they didn't bring the hammer down. So that's what the questions were. Where was the problem? If regulators knew that banks like SVB weren't prepared for a higher interest rate environment, where was there a moment where they stepped in so we didn't have this moment that they failed? So a lot of talking points like that. Also, what you're going to hear from Republicans, they're going to want to point out things like ESG, that these banks were too focused on diversity and other what they would call woke policies and not the bread and butter of banking. And from the Democrats, the line time and time again is going to be regulation, and they're going to point the finger in 2018 when Congress deregulated some of the standards for small and mid-sized banks that was originally under Dodd-Frank. The problem with that, though, is that, remember, Democrats also voted for that.
Right. Anne-Marie, we're looking at the ranking member, Maxine Waters, Representative Maxine Waters, talking now. Yesterday, we really got a highlight of, okay, banks over $100 billion are going to probably have to look at more regulation, and that landscape changed a lot. Anything more specific that we're going to hear in terms of that, you think?
Potentially, because that came out of Michael Barr, the Vice Chair of Supervision's own mouth. They're talking about potentially at the Fed, they need to up the liquidity, up the capital requirements for these types of banks that are in the $100 billion range. So potentially the supervisors, these regulators, are going to give their assessment. What was interesting, though, was Senator Elizabeth Warren asked all three yesterday, Treasury official, the Fed official, and as well the FDIC chairman, should there be more regulation? And she got a yes. But does that regulation come within the purview of these institutions, or does it need to be Congress doing that? And if it's going to be Congress, it is not happening with this divided government.
Right, and all the finger pointing, that kind of like goes with it at the same time. Anne-Marie, thanks a lot. Great to get your perspective. Anne-Marie Jourdain joining us from Bloomberg. All right, that brings us to the question of the day. When will the banking crisis hit the economy? And a large part of that is what banks do to their lending and their credit conditions, and what kind of regulation comes out of D.C., and then any kind of adjustment. And that's really going to dictate what the Fed also does. So we're going to try and figure that out with Mark Calabria, a senior advisor to the Cato Institute. He was a chief economist to Vice President Pence and the author of the new book, Shelter from the Storm. Mark, welcome. Great to get your perspective. All right. It's an unfair question of the day because no one knows the answer to it. But when does the banking crisis hit the economy? How do you see it?
I mean, let's start with what we do know.
Okay.
We're absolutely going to see the regulators clamp down on credit availability from community and regional banks, and that's going to slow the economy. And so that, I think, is a given. The question is really how soon, and I think we're going to see this over the next 6 months. So if, it's going to be more on the business side. If you're a home builder trying to get a construction loan over the next 6, 12 months, it's going to be harder. And so you're going to see that flow through. And you don't need Congress to be involved in that at all. We've really seen that projection. And if there's anything that regulators do when they feel like they've been embarrassed and caught off their job, is they overcompensate. And that's absolutely what we're going to see going forward. It is important to keep in mind that the banks we've seen so far really are outliers. With the problems at Silicon Valley Bank, the problems at Signature, sure, every other bank's probably got 1 or 2 of those problems, but no other banks in large numbers have like 5 or 6 of the problems they had. So I think that if you really want to know whether there's going to be problems in the banking sector, continue to watch the job market. If we start to see jobs really kind of crater, which we haven't yet, If we start to see that weaken, you start to see delinquencies. Because again, remember, the problems so far have been losses in the securities books. They haven't been direct credit losses on loans yet. And when that happens, then we're really going to have problems, when it happens.
If and when it happens. Mark, the issue here is that we're trying to figure out where to look. And as you say, the labour market may be a good place to start. We can maybe look at some of the term funding data and some of the deposit data. The US has a lot of banks. It has a huge amount of banks. So first question is, do we have too many banks? And the second question is, do we have too many banks to accurately have a handle on what is happening?
So, I mean, I think that it's important to keep in mind that community banks and the large SIFIs, the mega banks and the regionals, all play different roles. You know, it's important to be able to go to a community bank and get a construction loan, a small business loan. You're not going to go to Goldman or even a Wells and get that kind of lending. So I think it's important we have those institutions. Certainly, per capita, we have one of the highest banking per capita than anybody in the world. So we have a lot of banks. There'll continue to be consolidation. As a reminder, since 2008, we lost about 6,000 banks. And, you know, we'll probably in the next couple of years lose another 1,000. So I think there'll be consolidation regardless of what's going on. And how do you get that where you still have the lending that you need in the economy to support that? Because, again, the community banks play critical roles.
Well, then to that point, Mark, a big focus is going to be what happens to their net interest margins and then what happens with their deposit beta. So if they have to wind up paying more for the deposits to keep the deposits, that's really going to hurt their net interest margins, which then also hurts their ability to lend. But if they don't do that, then they're going to see potentially more outflows to, say, money market funds. How do you see this playing out for banks?
I see it playing out quite ugly. They're going to get squeezed. And let's actually remember, in the year before these bank failures, you already had about $800 billion leave the system in terms of deposits. So remind everybody, we had almost $5 trillion in deposits flow into the system during COVID because there really were no alternatives. But when you're getting essentially zero on your deposit, and you can get, what, 4% in the neighborhood of on a 3-month treasury bill, you're not going to leave it in the bank. So my assumption at a minimum for the next 12 months, we're going to see $1 trillion, maybe even $2 trillion in deposits leave the banking system regardless of what the regulators do. And of course, a lot of that's going to go in money market mutual funds. Some of it's going to go in treasuries. And of course, money market mutual funds that lend to commercial paper support the economy. So it's not as if the money's going under the mattress. But, you know, banks are going to face a lot of stress. The net interest margins are going to get squeezed. They're going to have to pay a lot more in loan. It's going to be a tough ride for the next 12 months for the banking industry. Absolutely.
And regulators, as you say, are likely to make it tougher and maybe overcompensate. Mark, what problem are the regulators looking at right now? What problem are we trying to solve here with the hearings that are happening on Capitol Hill right now?
Well, let's divide this between what the regulators are trying to achieve, which is largely to survive these hearings. You know, having sat I've been in there where the sole witness for 4 hours and getting grilled by Congress, it's tough. And you want to come out with your story and you want to get through what'll be a lot of partisan mudslinging and shifts of blame. So what the regulators want to achieve is to try to say they didn't screw up or that, you know, it's the institutions that are blamed. And of course, nobody's minimizing the blame that goes to management. But regulators also want to try to paint a picture forward and restore Congress's confidence in them as regulators, which really does mean they're going to overcompensate. For Congress, of course, it's going to be Democrats trying to say Republicans are to blame and Republicans trying to say Democrats to blame. And really what to watch for today is whether there's any bipartisan feeling for legislation. I'm pretty skeptical. I think Anne Marie was right earlier. Highly unlikely we're going to get legislation coming out of this.
So, Mark, I guess the other question is, what should, though, be fixed? Because I was speaking to the former chief innovation officer at the FDIC yesterday, and he was saying that the FDIC is like stuck in the Stone Ages. Like they're still like, scanning documents on a copier. Like there's like no ability to innovate in that respect. There's also ideas that SVB could have made it through if they just were able to get to the discount window at the Fed like 3 minutes earlier. Like these things are not up to modern banking. Is that something that can be fixed?
I mean, certainly there's a timeliness, and the data that you get is always kind of stale, which is why you want the examiners and regulators on site. And you got to have a little bit of gut reaction there. But I would say the problems at Silicon Valley Bank were obvious for 6 months or more. There's some question to this. How can you empower the regulators to act quicker when there's a lot of pushback?
Fair enough.
Mark, final quick question. You've got a cost of money question, which is the rates question, and then you've got an availability of money, which is the kind of the regulatory story that goes around it. If the regulatory story tightens up around the banks, does it therefore mean that we can have a lower cost of money, i.e. the Fed doesn't need to go as far?
Yes, it does, because the credit tightening will certainly be deflationary. I think it's highly likely, however, that Powell's going to wait for that to happen first rather than try to anticipate that. So we will likely have a 6-month period where the Fed is still at least standing tight, maybe even a quarter basis point here or there, before they're waiting to see what the regulatory impact is. So again, I think we're going to have a 6-month window where it's going to be a very uncomfortable ride. But I do think if this pulls back on demand because of credit lending, that the Fed will be able to ease off quicker. Absolutely.
Yeah, it's interesting. We've gone from kind of pricing more hikes to pricing more cuts. Maybe we'll go to pricing kind of hikes, then hold, then cuts. But we'll see what the market does. Mark, great stuff. Thank you very much indeed for the analysis. Mark Calabria, thank you very much indeed. This is Bloomberg.
Like Bloomberg.
All right, one stock we're watching here is Lululemon, up 13%, rallying the most since March 2020. Things looking relatively okay. China could be a significant opportunity here. They're dealing with margins a lot better when it comes to their inventory guy. A solid move in the stock.
Yeah, so two things to say, one of which is, Alex, this is far too fancy for Alex Lululemon.
Can't do it.
Doesn't do that. The second thing is, well, they've worked through a whole load of inventory, and B, I do wonder whether people have now worn out their yoga pants and are now needing more of them. That would seem logical to me.
Okay.
Because they bought a lot of them during the lockdown.
You literally made that up on the call, though. Like, do you have proof of this? Like, have you worn through your Lululemon pants?
Absolutely none of it. I said it's a theory. I said it's a theory. Anyway, we're going to take you back to Capitol Hill next. Back to banking. This is Bloomberg. So day 2 of the bank hearings, we're into the opening statements. We'll take you to the Q&A when that happens. But let's, in the meantime, get back to our question of the day. When will this banking crisis hit the economy? Because it's not showing up in the data right now. You saw consumer confidence data yesterday, really quite strong. We've got PCE coming up later on this week, got a whole bunch of data next week. All of that is backward looking. So what are we going to be looking at here to get an understanding of when this banking crisis is going to have an impact? Kathy Entwistle, Morgan Stanley Managing Director, joining us now to help answer that question. Kathy, what are you looking at to try and get an understanding of what is happening here? We think there's going to be a tightening of lending standards. We don't know how that's going to impact, A, the economy, and B, the market. The 2 years all over the place. The market feels like it's all over the place. Give us some guidance on what you're looking at.
Yeah, great to be here. And I will say we're looking at a few things. There's a lot of concerns with this banking crisis in the sense of these are a lot of regional type banks or specific banks for areas of the market. And if these smaller businesses or these companies don't have access to lending, they're not going to be able to run their business properly. So that's a big issue. The consumer and small businesses are what drive the economy. And if they have issues accessing capital because the regional banks are struggling or not willing to provide that liquidity because they're being more cautious, then we're going to have some issues.
Kathy, what I'm trying to understand, though, is that going to be isolated by industry? As in, okay, commercial real estate is going to be tight. We know that C&I lending has already kind of reined in a little bit. Maybe some tech lending is going to be reined in. But is that going to hurt the average consumer who still has a job, still making money, and can still go out and do stuff?
Well, in terms of if it's a small business owner, it's going to affect them. And that is the vast majority of employees and workers in the country are small business owners or working for small businesses. So it will affect the general consumer. And the second place it can affect it is when corporate earnings get affected, i.e. corporations need to roll over bonds that are maturing, borrow at higher costs than they did 10 years ago. It's going to be an issue too. And that cost of capital has to go somewhere. And it's going to go into the earnings, and it's going to hit the bottom line of the price stock, which will affect investors. Yep. So we'll see it there as well.
Where are we looking for evidence that this is happening, Kathy? Because we're almost in a situation where when we see the evidence in the backward-looking data, it's going to be too late. The impact will already be happening.
Yeah, it's interesting because the duration risk that has been mismanaged in some of the banks that we've been seeing can also be occurring elsewhere. Hopefully not, but that's going to be a shoe to drop per se if we find out that other banks made that same mistake. It's common knowledge in the financial world that when interest rates are rising, you want to ladder your fixed income portfolio. And when interest rates are declining, you want to, bullet point or barbell that fixed income. It sounds like some of these banks barbelled and forgot to go back and ladder once interest rates started to change, and that's the issue.
So, Kathy, putting money to work then, what do you do? Especially with the whippiness in the Treasury market, is that really safe? Money market funds are 5%. Tech, though, continues to get a bid.
Yeah, I know. Actually, what we're trying to do right now is continuously roll out of the more aggressive part of the market where probably it's overpriced, and take slowly but surely some money off the table there, put it into some of that cash that is paying quite nicely right now. And, treasuries are the risk-free rate of return, and so treasuries are the risk-free, investment. So you are safe there. It's just a matter of keeping some of your money short to deploy into equities once we see a correction in the market, which we still think is going to come. We think we're at the beginning of the end of the recession, and there will be a little bit more pain before we get back to normal again.
Kathy, I hear what you're saying about treasuries being theoretically risk-free. The 2 years all over the place. This is crazy volatility that we're getting at the front end of the curve. The market has no idea what's going on. How safe is a 2-year treasury right now?
Again, a two-year to me, when you're an investor, is a short-term period of time. And if you're going to know that you're holding that money for 2 years, even if it's whipsawing around, you should be okay. Now, of course, the fixed income market did get a little thrown off, a little rattled recently with this banking crisis, and that's just another example of what can occur. And we do have to be a little bit wary of what's out there and what else can happen. But in terms of, the whipping back and forth, it's going to happen when you have the opportunity to get in at a little bit higher prices or better yields. Take the advantage then. You can buy treasuries every day, every minute on the market as long as the market's open.
Kathy, thanks a lot. We really appreciate it. It's good to hear how you're thinking through this because it is really hard sitting up here trying to think through it at the same time. Kathy Entwistle, Morgan Stanley Managing Director, thank you so much. We now want to take you to Washington, D.C., where the House Financial Services Committee is holding a hearing on the failures of SVB and Signature Banks. We all have, all the officials have now given their opening statements. We're now going to begin questioning.
I believe it was Thursday evening, staff came into a meeting I was taking.
Thursday evening. Yeah. For Silicon Valley Bank. Okay. Along those lines, and you had a staff presentation in February that included Silicon Valley Bank and the distress because of rising interest rates on their portfolio. What did you do between that February staff presentation to you and the week of March 6th about Silicon Valley Bank?
Staff presented on the interest rate risk.
Yes, that's what I said. That was the February presentation. What did you do as Vice Chair of Supervision between that time and the bank, the week of the bank failure?
Staff indicated that they were completing their review of the bank and of this broader horizontal review at that time, and I was waiting for the results of that review.
Were you aware of Silicon Valley Bank raising capital the week of March 6th?
I believe I became aware of that in this email that I described to you
on Thursday morning. That they had successfully raised the capital, but they're facing financial distress.
I was not aware Thursday morning that there were deposit outflows. I was trying to finish the answer to that question. I was aware of the difficulty Wednesday night in raising capital, but the bank was reporting to supervisors Thursday morning that deposits were stable.
When did you become aware of the deposit flows? On Thursday.
Thursday afternoon, late afternoon, I became aware of deposit flows, and Thursday evening that there was essentially a bank run.
So Thursday afternoon, which could be mid-morning in California? Is that what you're suggesting?
I believe it was around noon in California, and for me around 3 o'clock.
Okay. And did you make provision for the discount window or pledgeable assets at that time you heard of their distress?
My understanding from the staff is they were in discussions with the bank itself beginning Thursday afternoon to try and move pledgeable collateral over to the discount window. That work continued Thursday afternoon, Thursday evening, and actually overnight.
Did you make provision to keep the discount window open so they could provision collateral to avoid a bank collapse?
The discount window opening decision is sort of like a standard thing. It normally closes.
A standard thing, except in a moment of crisis. It can be kept open. I think the Vice Chair for Supervision should be able to make that phone call. Did you provision for that? Or did you think you needed a provision for that?
Mr. Chairman, at the time, my understanding was that the difficulty wasn't sending funds. The difficulty was actually getting the collateral, evaluating the collateral, and getting it pledged to the discount window. And staff were working with Silicon Valley Bank basically all afternoon and evening and through the morning the next day to pledge as much collateral as humanly possible to the discount.
So on Friday morning, Vice Chair, Chair Grunberg, you were appointed receiver. When did you become aware that FDIC was going to have to take this measure or was going to receive this bank?
I think when we were informed Thursday evening.
I mean you. Were you informed Thursday evening? I was
informed Thursday evening by staff.
Which meant you had Friday morning conference calls to make a decision. Was that part of it?
I think we were, I think we knew Thursday evening that the bank was going to fail and that we needed to make provision to take over the institution.
Did you pick up the phone and call the Vice Chair of Supervision at the Fed and say, how can we provision to keep this institution open for a Friday?
I can't recall that. My recollection is, Mr. Chairman, that the institution was experiencing a liquidity failure and that it was going to fail. And
it was going to fail on Friday open or Friday evening? Were you provisioning for this for the weekend decision?
No, I think the expectation and their experience was that the institution was going to be closed in the morning.
At what point did you open an auction for Silicon Valley Bank? On Friday?
I believe it was Sunday afternoon.
Sunday afternoon, you opened for auction. So that weekend, what happened we only heard the announcement of Congress receiving this information at 11:20 on Friday morning. There was an idiosyncratic bank. And Sunday afternoon was the next pronouncement from any of you three on the panel, and it was a systemic risk designation. That's what shook the market for the last 2 weeks. That's the reason why we've had these extraordinary interventions in the financial system. And I want to know the key details of that weekend. I hope we can drill into those questions.
Sure.
With that, I'll recognize the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chair Gruenberg, we know that SVB Bank, nearly half of all U.S. venture-backed startups, potentially tens of thousands of companies, which clearly pose a concentration risk to the bank. While most of the bank's depositors were small and mid-sized businesses, they also had large customers too, with the top 10 accounts holding more than $13 billion in combined deposits. Chair Gruenberg and Vice Chair Barr, I'm concerned that depositors' decision to run or stay were not necessarily made on their own, but by the strong encouragement of their venture capital backers who sit on the boards and hold equity in their companies. Were a handful of large venture capital depositors able to influence the withdrawal of $42 billion all at once through their control over their portfolio companies?
Congresswoman, I think that is something we'll need to look at in terms of the post-failure review of these institutions. I couldn't tell you today, with certainty what occurred there. I know both the Fed in regard to SVB and we in regard to Signature are going to do a careful review of the events that occurred.
Thank you very much, and I agree with you. I think we really need to know the role that venture capitals played in this bank. Going further, Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, which is considered deficient, but was considered sufficiently capitalized, given the bank's unique customer base, extremely large share of uninsured deposits, and underwater asset portfolio. Liquidity management was also a key issue. The liquidity rating for a bank should account for interest rate risk and the bank's asset liability management. What was the bank's rating on liquidity?
Thank you, Representative Waters. My understanding is in the summer of 2022, although the composite rating was a 3, that is not well managed, the liquidity rating was a 2, which would have been satisfactory. And one of the things we're looking at in the review is how that synced up with the supervisory matters requiring attention and matters requiring immediate attention with respect to liquidity that had previously been issued. So we're looking at whether those standards were sufficiently stringent, whether the firm should have been downgraded further, and whether further supervisory steps should have been taken.
Whose responsibility was it, understanding the deficient rating, to do something?
The Federal Reserve is responsible for supervising this institution.
Did the Federal Reserve fail on that?
I think that anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
Thank you. Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, and you just responded in a way that says, yes, that is true, and perhaps something should have been done, and you're going to look further at that. Are you suggesting perhaps legislation to deal with that?
We're focusing in our review on our own supervision, ways that we could have done better as supervisors at the Federal Reserve, and ways that our own regulatory structure might have played a role with respect to the failure of this firm. So we're inward looking. It's a self-assessment, a prudent thing, I think, for us to do. It's what we tell banks to do. It's sort of the first thing you have to do to understand risk within your own institution, and that's why we're doing it.
Chair Barr, I wonder what it would take to receive a 3, 4, or 5 from a federal examiner. Well, I know the idea is to keep exam ratings confidential in order to prevent bank runs, but doing so also prevents this committee from understanding how well the Fed and other regulators are doing in rating banks. In the same way that stress testing results are public, are there ways we can make the supervisory process more transparent to promote discipline and accountability?
Thank you, Representative Waters. I think one of the things we're trying to do here today is to provide that accountability, and we'll do that in our report, which we'll do on May 1st. It will include confidential supervisory information. We normally do not provide that information, but given the fact that this bank failed and triggered a systemic risk exception, we're including that information, including exam reports.
Thank you very much. Very important issue. Chair Gruenberg, Silicon Valley Bank was purchased over the weekend by First Citizens Bank and Trust Company. As you know, I wrote to you on March 18 about former SVB's Community Benefits Plan, which was intended to provide $11 billion in small businesses, housing, and community development support to communities in my home state of California and in Massachusetts. I understand that $2 billion in affordable housing and other projects may be lost or delayed in California because of the failure. Will Citizens Bank and Trust continue implementation of the former bank's Community Benefits Plan?
The agreement between the community organizations in Silicon Valley in regard to the community benefits agreement was an agreement between those two parties. First Citizens will now be taking over Silicon Valley. There'll be an opportunity for the community organizations to engage with First Citizens. I know First Citizens has a community benefits agreement with community organizations where it's currently doing business, so there'll be an opportunity for the groups in California to engage with Citizens. And I would note Citizens is also subject to supervision under the Community Reinvestment Act. And so we'll be able to evaluate the degree to which Citizens is serving its communities pursuant to CRA.
Gentlelady's time has expired. We'll now recognize the Vice Chair of the full committee, Mr. Hill of Arkansas, for 5 minutes.
Thank the chairman, thank the ranking member for this prompt hearing after these weeks of tumult, and thank the panelists for being here as well. Mr. Barr, when were you nominated for your job?
I apologize, I don't have the date in my head. It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no Vice Chairman for supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how's that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written response.
Yeah, if you get back to me, because what we're saying to my colleagues here is that from the turn of administration, we did not have a Vice Chairman of Supervision from January 20, 2021 until July of 2022, and that is precisely the time frames, colleagues, when this bank's business strategy went awry and was under this supervisory concern by the San Francisco Fed. So I just want to have that in the record. And when I look at the results of this bank and the UBPR, the call report data, and looking at your good testimony about the timeline that you've disclosed, it appears to me that we have a lack of supervisory urgency here. You outline that the trends in 2021 are what triggered concern by the Federal Reserve examiners, and I assume the state of California. We haven't heard from the state of California. We'd like to. But there was an exam in the summer of 2021, and then there was, it took till the fourth quarter of 2021 to tell the bank we had some specific serious concerns, so that you met with the board then, not you, but the supervisors. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raise an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and what they were noting? And we're going to look carefully at that.
Yeah. I just was shocked with the business plan, way out of line with peer. You have matters requiring attention, which is a very low level, the lowest level editorial comment by a bank regulator. There was no proposal for a board resolution that I saw in your notes. So I look forward to the results of your comments. On this issue of Dodd-Frank versus S-2155, my reading of bank law, those things are just almost not important compared to 12 U.S.C. 1818 on cease and desist, where the FDIC, the primary bank regulator, the state can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open?
You're listening to questioning by Congressman French Hill from Arkansas. This is part of the House Financial Services Committee hearing into the failures of SVB and Signature Bank. If you'd like to continue to watch this hearing in real time, you can certainly do so. Your Bloomberg device will allow you to do that. You can go to Live Go on your Bloomberg. The hearing continues. This is Bloomberg.
Equity markets in the U.S. are off the highs, but they're still holding up. The Nasdaq 100 is up by 1%. I want to get to some individual movers here and dig a little deeper. Micron obviously doing really well. They came out with a better than expected quarter outlook. So the idea is that maybe the chip sector is bottoming, may not necessarily recovering, but bottoming, and that's good news for the space. On the flip side, Lululemon just kind of crushing it, seeing its best rally since March of 2020. Basically, their inventory management is getting a lot better. China could be a catalyst. All of that in there as well. I just also wanted to highlight Bed Bath & Beyond and Ross Stores. They're pretty much the draggers on the S&P. UBS downgrading these guys along with Urban Outfitters on an increasingly bearish on soft line retail stocks. So a little bit of divergence then when it comes to retail, which I thought was quite interesting, Guy.
You're actually seeing some weakness in retail over here as well. Next, talking about a challenging year for UK retail. That stock certainly taking a hit here in Europe right now. What is interesting is that the stock 600 is high. We're up by 1.14%. The reason for that, actually the real estate stocks are bouncing back. So names like Vonovia, which got battered yesterday, just recovering a little bit of that lost ground. The tech sector is front and center, but it's the banks once again that we are focusing on. UBS up by 3.66%. Sergio Motti is coming back. The big concern here is around what is happening with operational risk around this business and how you put these two businesses together, CS and UBS. Motti may be able to make that happen. CS maybe will become part of UBS in an integrated and relatively straightforward fashion. UBS up by 3.7%. And Brent Crude, I think Brent, we're not talking about it much at the moment. It's interesting to see how the kind of the TI contracts and the Brent contracts are shaping up. Where's the economic slowdown happening? I think that's a question that we definitely need to be asking ourselves. Okay, coming up on the close, Alex, we need to be talking about what is happening in terms of the renewable transition that we're all watching so carefully. EDP, the Portuguese energy company, is going to be joining us next. The reason for this is this company is a huge investor in renewables. But the big question at the moment is, how is the IRA, as we're calling it over here now, the IRA, the Inflation Reduction Act, impacting how European companies are behaving? And that's going to be a big subject of discussion, Alex.
Yep, indeed. And also where you allocate capital if overall cost of capital for companies is going to increase. How do you then figure out how to allocate it? The pie gets smaller then. What do you wind up doing? EDP is also interesting because they're also into natural gas as well. So getting their take on storage in Europe and how they're kind of preparing for next winter, having gotten lucky through this one, will be quite interesting. So obviously we're both jazzed. It's energy. We'll talk about that next. This is Bloomberg.
Great questions.
Wednesday, the 29th of March. European equities are looking pretty good today. Tech's having a good day. The chip stocks are definitely having a decent session. We're watching the property stocks bounce back, but to be honest, it's still all about the banks. We need to talk about UBS. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's talk about single stocks. I showed you Infineon just a couple of moments. I showed you UBS a couple of moments ago. Infineon is a stock you want to pay attention to as well. Chips on both sides of the Atlantic. Take a look at the Micron earnings. Take a look at the Infineon earnings. Looking good right now. Alex will show you Micron in just a moment. The UK 2-year, we're seeing stabilisation, I think, in the UK housing market. What does the Bank of England do next? Inflation is still pretty hot. That's a question the market is asking itself right now. The Stock 600, though, is up, fading a little bit, but still up. Up by 1.1% at the moment. The commercial property stocks have come back. Stocks like Vonovia are doing much better today. You've got tech, look at Infineon, doing relatively well as well, Alex, but it's still about the banks. And the surprising news out of UBS, certainly catching everybody on the hop today.
Yeah, that was a what when I checked my email early this morning. All right, S&P is up 0.8, so we're off the highs, but as you pointed out, Micron really helped pushing overall tech higher, up by a nice 5%. We'll get to, like, is it a bottom or is it an actual recovery in the semis throughout this hour as well. Another outperformer, Lululemon, surging the most since March of 2020. One interesting point, yes, it was inventory management, but they're also sort of paring back from their Lululemon Studio, which usually was known as Mirror, and moving more towards app-based stuff, which in theory then could help trim some costs. I thought that pivot was also quite interesting. The 2-year yield also, you have some buying coming in, but we are above that 200-day moving average and kind of holding it, which is quite interesting when it comes to the yield. And the S&P, though, right between the 50 and 100-day, I just feel like we're kind of bouncing around there, and I just wonder what the catalyst is going to be for a breakout either way, Guy.
Stuff. We're back to stuff. Yeah. Okay, let's talk about UBS. When you've got the kind of choppiness that we've seen in this stock over the last couple of weeks as a result of the deal to integrate CS into UBS, you need a steady pair of hands. Sergio Ermotti certainly, it seems, possesses a steady pair of hands because the market likes what it heard today. It likes the idea that he is coming back. Alex, this has been the story since that CS deal was announced. The stock is actually higher. We've been regaining some ground, but there's significant execution risk around putting these two companies together. And maybe Ermotti is the right person to make that happen. I just wonder whether he's dusting off an old playbook that he'd already written and now he's finally going to get to put it into action.
Yeah, and it's worth kind of going back and looking at the skill set then that Sergio Ermotti had, and then how it can be applied to this merger. So we went back and took a look over the years. Bloomberg TV's interviewed him a bunch of times and tried to get a sense of the kind of manager he is and what he'll bring.
UBS has named interim chief executive Sergio Ermotti to take the job permanently.
Sergio Ermotti has got to do three big things. He's got to convince the shareholders that he's got to control risk. He's got a grasp of what's going on in the investment bank. He's got to bolster wealth management and reduce leverage.
Bloomberg's been speaking to the new boss of UBS, Sergio Ermotti.
Sergio, great to have you with us today on Bloomberg. Sergio Ermotti, welcome to Bloomberg, sir. The best quarterly profits since 2010. On each occasion when we've sat down with Sergio Ermotti, he's had a great numbers story to tell. You're 3 years into this. Give yourself a mark out of 10. How have you done?
It's Christmas time, so I'm gonna be very generous with myself. So I give a lucky number, 8.
Orchel is gone. Zellner is gone. Are you all in and committed to this bank going forward? What do you want to say to the market today?
Well, I'm committed.
Sergio Ermotti, welcome to Bloomberg. Your final set of results after 9 years at UBS.
Can I just say that I think Sergio Ermotti didn't age a day throughout that entire process. He looks amazing. The rest of us, Alex, I think we've aged a little bit during this time. I'm not actually gonna. I say me. Maris, no. Francine Lacqua, definitely not.
Well, okay. I could definitely make fun of you for your like completely brown hair that we saw, but I should point out that back in those days, I had hair that was like down to here, and I had like lots of extensions in it, and it was kind of crazy. So I'm not going to give you too much shade for that.
I think the real takeaway is that Sergio Motti still looks fantastic.
100%.
And he's got a bit more wisdom, I suspect, and he's got a few more ideas, but nevertheless, he hasn't aged a day. Our question of the day, though, is a fairly straightforward one. How do you value UBS? There is significant risk around this business. Motti is back. Does he reduce that risk? Does he have a playbook for making this happen? Francine Lacqua is with us. She definitely hasn't aged a day over that intervening period. Steve Aarons joins us from Frankfurt. He may have a few more grey hairs after covering Deutsche Bank. Fran, I'm going to start with you. Motti's back.
Yep.
You look great, by the way. Motti's back, and this has been talked of in the past, putting CS and UBS together. Do you think he's got kind of in the bottom drawer, he's got like a playbook?
Yeah, probably. It's very frustrating actually interviewing both him and Jamie Dimon, because you come back to the office and everyone's like, did you ask him about how they work out? How do they look still so young? So that is frustrating.